Hey guys, what's up? It's me, Jonathan, and welcome back to Money Talks, where we want to offer you financial information and meet you where you are financially so that you're able to stick to your budget, manage to pay off your debt, and begin to save on your path to building wealth. Today, I want to talk to you a little bit about the things that people start to overlook when it comes to trying to pay off their debt, but also the hidden fees and the hidden charges that can come inside your loan. If this is your first time joining me here on the channel, go ahead and hit that subscribe button and you'll be notified every time I upload a new video. So a lot of times it can become cumbersome just to try to manage to pay your loans, and when you're trying to organize and prioritize, what do I pay first? Like this pandemic, many times people didn't really know which bill to pay first, which loan to pay first, because they didn't fully understand all the features of that loan. And when I say that, meaning, do you know the grace period? Do you know how when certain things are reported? Do you know the interest rate? These are common things that people tend to overlook. But when you think about even just trying to get your finances in order, or if you're really on that track to try to pay off your debt, these things can be helpful. And they also can be helpful for you to understand why, know what will happen should certain things change in your loan. So let's get right into the video. The first thing I always want you to do when you're thinking about a loan, you have a loan or refinance it or trying to pay off debt, really look at your interest rate. Your interest rate pretty much is the simple way of saying it is, this is what you're paying the bank to borrow the money. And oftentimes people run to refinance just because they can lower the interest rate. Well, as I discussed in the refinancing video, sometimes it just doesn't make sense to refinance that interest rate, because at the end of the day, that's a percentage, and you want to look at the specific dollars that you may save or how your payment may change when you're looking at refinancing the loan. But when you look at the interest rate, whether you're buying a car or buying a home, you really need to understand what's the dollars that equates to should you have that loan for the 5-year period, or should you have that home loan for the 30-year period. Understanding how that plays a part will help you understand the importance of, can I get a lower interest rate? Should I be having a conversation with this lender to negotiate down the interest rate that they're charging me? And in the case of a home loan, am I paying attention to the interest rate and also the annual percentage yield? Because that will tell me how much I'm actually paying in fees to this lender to borrow money to buy this house. Which, when you think about any object that you're borrowing for, you want to look at the total cost that is involved. The same thing can be said about a car. It's not just the interest rate, it's the fees, it's everything associated to understand the total cost that you pay for a car. But it's very important to understand, in the car scenario, realize the highest level that you pay is only going to get worse from that, because the car, again, loses value as time goes on. So I really want you to pay attention to the interest rate. What I've found with a car interest rate is, number one, understanding that because of how your loans are structured, yes, they're closed in, but that interest isn't charged to you equally throughout the loan. The home loan and the car loan and the personal loan, whatever loan you have, they charge majority of your interest within those first few years of you having the loan. So if you're going to refinance your interest rate or anything of that nature, the time to do that is usually, especially within the car, within that first year to 18-month time frame. Otherwise, it typically, when you're looking at how much you're paying in interest, it probably won't matter after that. The second thing is, when you're looking at a car refinance, you really want to be careful about what's kind of the sweet spot. What I've found in doing loans for people and helping people walk through this process is, it's usually on a car about 3 percentage points down. So if you have a 9% and you're about to go to a 6% or lower, that would be an excellent opportunity no matter what the cost, because you're going to automatically save. But if you have a 5% and then you're going to a 2%, then you have to really look at your dollars a little bit more intentionally so you can understand, hey, is this actually really worth my time based on how much I've paid into the car? Remember, with your interest rate and with these loans, you're always charged majority of your interest rate up front. Now again, to the home, if you're going to refinance in a home scenario, that looks a little bit different. If you're about 0.75% or 1% in savings with a home, you usually can break even on that in about 3 years. But you still want to look at how much you're saving, how long you're going to be in the home, and then really think about what are you paying to get this done. See, with a car refinance or with if you get a personal loan or something of that nature, you don't usually pay to do that loan. But with home loans, you're going to pay if you purchase. You're going to pay if you refinance. So that is part of the equation of, is it really worth what I'm spending to get that savings? So it's a little bit more intricate and a little bit more layered. The second thing I want you to understand is forced place insurance. Now, when you buy a car, you have to have full coverage insurance. When you buy a home, you have to have homeowners insurance. And you have to have it legally by the specified guidelines. So when you don't have insurance from your car, the people who carry your loan are notified by your insurance company that your insurance has lapsed. And that's when forced place insurance by the lender, the bank, is put onto your loan. So have you ever been paying on your loan and kind of looked at your balance and noticed that, hey, my balance has increased? Well, that's because likely if you dropped in coverage, that forced place insurance has gone onto your loan. There's a couple things you can do. Number one, you can go get insurance. If you have insurance throughout that time, you can show that and they will drop your forced place insurance, because that would be fair because you had coverage. If you don't have insurance during that specified time, then they'll likely keep that charge there. But understand, it's costing you more for the lender to have insurance for you on the loan than you to go get it yourself. And I mean, it's dramatically more. So the same thing can be said of a house. It's really important that you watch this, because this can impact how much, again, you're paying for your loan, because your interest is dictated off the balance of your loan. And the whole point of you paying down this loan is how much money you can get to the principal. How many principal dollars can you get going every month? Because that's what's going to accelerate your loan payoff. The other thing I want you to think about is fees. Now, in not just fees of when you're purchasing. So in a car loan or in a home loan, you may have titling fees or application fees or appraisals and all those different things. But I want you to think about the fees after the fact. A good question for you to ask when you're getting a loan and when you're, even if you already have a loan, is, hey, what's the grace period? Most lenders do give you a grace period before you're charged any type of late fee. But once more, if you're going to be late, well, you actually have to be exactly 30 days late before that lender puts a late inquiry on your credit. Well, let's think about that for a second. So if your due date is the 25th of every month, but by the time you pay that payment, it's not fully, and it's the month of October, well, you have to get all the way to 30 days from the 25th of October to 30 days later, which would probably be November 25th. But it actually has to hit that day, November 25th, before you actually get a full 30-day late period. So think about that. Really understand, number one, what's the grace period that you're getting, but then also to help you know how to really effectively manage your credit. You may get a fee, but every time you get a fee of a late fee doesn't necessarily mean that you're going to get a late inquiry. You have to actually know the days. And that's something that can help you kind of manage your credit. Meanwhile, while you're trying to make decisions, maybe you're in a tight spot, this is something that you can kind of leverage on your end to help get yourself through without any long-term impact. Ultimately, you need to know what resources you have, and not all the time will someone share that information with you, especially in the case of if you have a loan, because if you're late, they want you to pay immediately. But if you know, hey, I know you guys can't actually put a late inquiry for 30 days, well, if you're in a tight spot and you maybe need to get a repair done or something of that nature, then you'll know, hey, let me go ahead and take this fee and maybe I can get it refunded, or I'm paying this, but I'm not going to get the late inquiry because I know I can pay it before that time happens. It's very important that you understand a lot of the rules to manage your credit, because there are some things you can do to even just help yourself. So what if you made a big principal payment on your loan for either your car or your home? Does your lender offer you a recasting feature? And that simply means without going through refinancing, they re-amortize the loan so that you're able to get the benefit of a lower payment. But you always have to look at how much money is going to your principal and how much is going to your interest. Because at the end of the day, it's no sense in getting any budget relief in the month if it makes you stick with the loan longer. Ultimately, I want you to think around your loans as a long-term plan to pay them off. But I want you to understand these key things, these key details, so that when you review your loans, understand what you're paying your money for and how that is charged. Think about it. Review your loans. Let me know in the comments, have you ever been charged for forced place insurance or gotten a late fee? Or did you know that you actually have to have 30 days late before you get a late inquiry? So a lot of things can be ambiguous about these loans, but hopefully this information is helpful for you. If you like this video, go ahead and give it a thumbs up, and I can't wait to see you guys in the next video.